Hello, good morning or good afternoon, everyone. Welcome to day 2 at 1-to-1 Mining Investment London. So we have a panel talking about investing across the EV value chain. So joining me up here today, we have Gennady Agrest, trader at Net Zero Resources, and Michael Parton, group manager for battery raw materials at Lucid Motors. So thanks both of you for joining us here today. And so maybe we could just start with a quick introduction to both of you, and then we can get into the questions.
Sure. So Net Zero Resources is a battery collection, recycling, and battery raw materials trading financing company, operating primarily for the time being in Europe and looking to expand into other jurisdictions. That's basically about us.
So Lucid Motors is the most advanced electric vehicle manufacturer in the world. We have 2 vehicles, the Lucid Air and the Lucid Gravity, both with leading range and performance. I'm part of the battery raw material supply chain team, so source things like nickel, lithium, cobalt, graphite for our battery cells.
Okay, great. So for this panel, as with all of the panels that I run, I want to keep it open for conversation with the audience as well. So if you have a question at any point, just put your hand up and we'll get a microphone over to you. So thought we could start by just looking at kind of the whole ecosystem. There's been a lot of talk over the past couple of years about the growing role of different players investing into the EV value chain. So whether that's government, OEMs, traditional investors. So maybe we could just start off looking at, what do you see as this network, and what sort of roles do you see across for all the different players?
I can start off with that one for a bit. I mean, one of the key things, at least for us, it seems in the Western world, is that you have the governments and sovereigns talk a lot about, developing, especially the midstream, but there still isn't that sense of urgency and enough capital allocation into the space, and especially in the upstream as well. I think that's when, the clear dominant leader in battery supply chains is China, right? It's undisputable. And what they have mastered and what they've realized is you've got to figure out the whole supply chain, right? Whereas it feels to me that, in the EV market, outside of China, especially in Europe and to some extent the US, I mean, you know better than I would, it's a bit scattered in terms of, how to secure raw material and how to build out those supply chains from start to finish. And governments need to do more to allocate capital, especially on the equity side. Debt, it's not readily available, but it's out there for funding. But the equity pieces are missing to bring online these massive capex projects. You need the upstream to feed the midstream. Building out the midstream on its own is very tough because it's a very low margin industry, right? So, I think one of the major steps is for governments to really act more thoroughly in terms of deploying capital in the space. That's the first thing I would say. And then we can touch on OEMs and other elements of the question, but I don't know what you think about that.
Yeah, so I have a very U.S.-centric view, since that's where we manufacture our vehicles, and that's where we're trying to create an ecosystem within the U.S. So in the U.S., there's obviously new reforms that are going through for permitting, so allowances for projects that are in the critical mineral space to get fast-tracked and get advancement in their permitting endeavors. But the question of where will capital come from to fund these projects is now very much in question. Things like the IRA is also in question in terms of what will be the future of that. There's been a recent announcement by the Congress of the reconciliation process with dramatic changes to the IRA potentially are on the table. So the question is where will the money come from on the upstream value chain, but then also for companies like ourselves, what will incentivize providers or OEMs like ourselves to purchase materials that are located in the U.S. when we know that those materials oftentimes need to be exported to places like South Korea, China, to get refined and turned into battery-grade materials for our cells. So there's kind of 2 questions of what is going to happen. A is, how will the incentives, how will capital fall to these companies? And then also, how do we find the value chain entirety within the United States. Right now, it's kind of the bookends. You've got the car makers, you've got the material companies that are mining materials out of the ground, but things like PCAM, CAM, still not really being invested in the U.S., and a big question mark on the future of the value chain within the United States for sure.
I mean, maybe we can look at the impact of changing regulations. I mean, as you mentioned, the IRA was such an important, bill or drive for the U.S. for the past couple of years, and now with the new administration, there's been a shift. So, how does that change how investors are looking at investing into the various critical minerals?
Yeah, I think there's certainly pause of not knowing the regulation, specifically around foreign entities of concern. So, wanting to put out capital, knowing that there might be another provider that provides capital that might be considered a foreign entity of concern, certainly could put you in the mix of being out of contention for receiving some of those benefits. Since the benefits sort of wash down, so it goes from the OEM downward to the material vendors, and that the companies like ourselves are incentivized to purchase materials within the U.S. or free trade agreement countries. They're not directly getting that impact of either the $7,500. We have to kind of find the sources, do a supply agreement with them, and then they inherently get the benefit for it. But with the uncertainty of what's going on, many people are pausing their efforts in getting IRA compliant materials. They're looking at what is the alternatives that are out there, and usually it's more advanced and developed companies that are able to provide the alternative to the IRA compliant materials within mostly Asia. And so it becomes tough. Do you still invest in domesticating the battery supply chain within the United States, or do you take the approach and assume that most of those subsidies will go away and then start to go back to sourcing things from China, from South Korea, from Japan? We're still dedicated at Lucid to try and go after domesticating as much as we possibly can, because we believe that regardless of the policy changes, regardless of the administrations, that there will be incentive to getting localized materials. It's something that's inherent in our nature to want to try and get everything out of the United States as we possibly can.
I don't have anything to add to that on the U.S. specific.
All right, no worries. Do we have any questions from the audience before we keep going on? All right, if you have any questions, just put your hand up at any point. So, thought we could look at, where the capital is most urgently needed at the moment. So, whether it's within kind of the companies that we have here or across other parts of the EV value chain. So, what do we need to focus our capital allocation to at the moment?
Well, I'd say to some extent you need closer engagement with proven capital allocators as well. It's not a guarantee of success if you do work with those who have developed mining assets before, but it's more likely than someone who hasn't developed a mining asset. Because the other thing with just capital on its own, the other thing that's lacking, I think, across the value chain as well is human capital, right? Is actually people who can build mines, operate them, build the midstream, operate it, and that unfortunately is not in place. There's just not enough human capital around to actually develop these assets as well. And that's another thing that I guess is a more medium-term thing to look at. You can't train those people overnight, right? It takes years to build out that talent, but that's another thing alongside just pure capital deployment. But in terms of where, I think across the value chain really, because every step of the value chain is complex, right? You have metallurgical and mining issues on the upstream. You have refining, processing issues on the midstream. So I think it's not just if you build one part of it, it is one fully. You have to build a vertically integrated supply chain, which is once again what China's done from mine to battery, right? So I think in my opinion, it's not just one particular sector. All of them have to be tackled, I think, in terms of capital allocation. So, yeah.
Speaking of capital allocation, do your firms actually invest in the upstream directly or just buy product, I guess?
So currently we're just buying products. So most of the players that we've worked with are usually more advanced developed players. So we're currently doing that to start in the future. As we mature as a company, we need more materials. There's probably more of a justification to investing directly with some of these mining operations. But as we're smaller scale today, we need a small amount of volume to suffice what's required. We usually find that it's more advantageous for both parties if we do an agreement where there's no money being exchanged other than the money changed for goods.
Yeah, and on our end, we're looking to. We're a relatively new company. On our balance sheet is not that expansive, but we are looking to do that more actively in the recycling side, where the ticket side is much smaller and the capex, the absolute capex number is much smaller. It's not, hundreds of millions or, even tens of millions in some instances. On our end, the other issue that we have, if permitting is an issue on the mining side, on the recycling side, it's the complex regulation. It's very hard to operate unless you have, it's a new market. The products being produced by recyclers are not uniform, as they are more likely to be from mines in the form of concentrate or MHP. And the regulation doesn't help with that. I know that there is an impetus to keep material kind of in-house, let's say in Europe, for example. But what that results in is, it's harder to create optionality in terms of where you can deliver material, how you can process it, what kind of intermediates you can deliver where, and so on. So that's to answer your question. Yeah.
If I can ask, the sourcing of the battery raw materials, what is the biggest challenge? Which material is the most difficult for you to get?
Graphite. So graphite, because its inherent nature with cell performance, becomes very difficult to source because we rely upon the cell makers to develop the cell parameters, and so they have a lot of intellectual property when it comes to defining a graphite spec. So graphite is definitely a difficult commodity to source in that you have that issue, along with the issue that majority of the graphite supply chain is controlled by one entity, which is China. So finding alternative sources of graphite is extremely difficult in that the market value for graphite is very low at the moment. Trying to find an incentive price to do an offtake agreement with a provider, the differential on Chinese graphite versus domestic graphite is significant. It's a multiple of 2 to 3x the cost. So as a car maker, my job is to try and keep the price low of what we're selling to our consumer. It's a very difficult issue to tackle, but we believe that it's one that is we kind of have to tackle first more than anything else because of the risk points. So we have 2 graphite agreements, one with Syrah Resources and one with Graphite One, looking to hopefully do others in the future. But those were the first things that we decided to direct source because of the criticality of those materials and the supply chain related to it.
If I may add, though, what I imagine the problem you face regularly is unless you can commit a prepayment, ideally equity, but even debt as well, into an asset, it's hard to secure raw material, right? I mean, because otherwise there's a lot of players out there who can do that instead. And that's how you build a mine. You need the capital to build it. So I think that's I would imagine the other issue as well. So.
Yeah, the prepayment portion of it is certainly something we get approached with a lot. And depending on the maturity of the resource, it's something that we have entertained, but generally speaking, depending where the prepayment sits on the cycle of development of the asset, for us, getting that back takes multiple years, and it's something where we have to consider, okay, do we help out our upstream vendor who has a chance of not being able to give us this material after 4 or 5 years of waiting? Or do we put it into plant expansion and starting to vertically integrate some of our procedures that we have in our car manufacturing plant, like body in white, paint, powertrain, all the areas of the vehicle where we can directly control the parameters. we choose to usually invest in that before we would choose to invest, outside into a supply chain that's not like a tier one or a direct tier two.
Michael, you spoke about how you want to, as a company, you focus on direct, like domestic investment. Is it the same for the actual bodies of the cars? So considering like aluminium and EVs, and when you look at what's happening within the United States and the aluminium industry, are you still focusing on domestic investment, or is that where you trade off and look for alternative sources?
Yeah, so before doing the battery raw materials like I do today, I actually did our sourcing for aluminum and steel for our body structures. So we were able to secure the majority of our aluminum supply from a domestic source within the U.S., which is now paying dividends in terms of our risk profile when it comes to buying material from out of the United States and being hit with duties. So yeah, we've certainly, aluminum is a large contributor to our body structures. We actually use more aluminum in our vehicle than anyone else. Even the structural components that would typically be made out of steel are made out of aluminum, which means that the capacity within the United States is a very key risk for us. So that's why we've gone out and secured long-term supply agreements for body sheet within the U.S. Also of note, we do produce vehicles out of Saudi Arabia, and we've also worked to secure material out of there as well through one of our I would say sister companies, which is Modin. So we have an auto body sheet agreement in place with Modin to provide that out of the kingdom.
So maybe we can look at some of the other challenges that investors looking into this space may face. So already kind of looked at different commodities and the challenges there, but what about, managing different chemistries or like battery chemistry, pricing of metals? How does that all kind of impact how you make some decisions?
So for chemistries, you have certain things that are kind of chemistry agnostic in a way. So lithium and graphite are both somewhat chemistry agnostic. Copper foil, aluminum foil, those are generally chemistry agnostic. But yeah, things like nickel, cobalt, manganese are definitely dependent upon what chemistry you end up utilizing. And so when we take a look at our sourcing activities, we want to make sure that we're creating that ability of flipping back and forth between chemistries. So currently, we're only using NMC batteries in our vehicles, but there is taking a look at other cell chemistries in the future. LFP certainly is of interest, given that we have a high efficiency within our vehicle. It means that we can use a lower efficiency cell, still get the same range that we'd be able to offer with other competitors, but at a lower price point. So with that, sourcing things that are chemistry specific is a little bit more of a risk for us, so that we don't have that flexibility of being able to flip between the two chemistries.
Could I just ask a follow up on that one? Do you see sodium ion as being a viable competitor to LFP and NMC going forward? And we've had developments by CATL in the energy density side. Is that something that could threaten battery supply chains with a lot of people looking to invest and develop them? Do you guys see that as something of a competitor to LFP and NMC? Or?
Not particularly, at least not for an automotive context. So for maybe other forms of transportation, I could see that being a viable solution. Also in the low commodity prices that we're seeing today, that differential between sodium ion and the cost of NMC or LFP on a $1 per kilowatt hour basis is significantly less. So with that differential being narrowed currently, it definitely means that we have less consideration for things like sodium ion. We have people from the company who I get this question almost every week, and the answer is almost always the same: is that it's we don't believe that the energy density is there, and that the price points are supportive of being able to flip over to that. So at least not now.
And so, how do you make decisions about what to invest in and how? So you earlier mentioned taking into account management of the companies and also looking at maybe more domestic sources. Are there other kind of key criteria that you might want to use?
some of the stuff on the primary side, you know, on the primary mining side, you definitely have. Yeah, I think there's certain fundamentals I think just to keep in mind. A lot of the time, we imagine is, you know, you want to be low down on the price curve, right? Ideally, you look at projects that are, you know, yes, that have that management team in place as well, where the metallurgy and the extraction is to some extent proven, to some extent, right? I mean, you see on the lithium side a lot of you know, new kind of extraction technologies that haven't yet been proven at scale. So ideally, you know, I guess I'd imagine the sweet spot or the priority is to find those kind of projects where it's a proven technology, kind of relatively understandable mining and metallurgy to the extent possible, because all these projects are complex. And yes, you know, the entry ticket might be higher than it is for you know, for an unproven technology, but you know, you have a more reliable, a bigger likelihood of the material being delivered, and, you know, produced on time and so on. So I think there's just certain fundamentals to look at. Jurisdiction, I guess, is another key one as well. Although, you know, you have a long timeline of when capital is allocated to when you actually get first product delivered sometime. But so it's inherent risks, and a lot of jurisdictions, even good jurisdictions, can change in terms of how they view mining or how they view, you know, kind of that segment. But yeah, those are the kind of things that I would say would be important.
Yeah, for us, things like IRMA. So we're a member of IRMA, and we look at resources that have gotten the. I know they don't want to call it a certification, but it's a analysis of the assets. So we definitely prioritize using companies that have that analysis done, and, you know, trying to make sure that when you are choosing out your supply chain, which takes many years to validate, many years to, you know, be able to get into place, that you're also putting the filter of, you know, what is not only like the price point, what is the, you know, the general supply chain, but also what is the, you know, the carbon emissions associated with this asset, and, you know, you'll always be tied to how that is perpetuated within your vehicle, and with things like the EU battery regulation, companies now will be having to disclose their carbon footprint. So taking a look at it now and making sure that you have that filter of, you know, what are the options for supply, and making sure that you are considering the carbon emissions from the sites will be critical and necessary, given the new regulations coming out in Europe.
I mean, I think a lot of the, you know, with the move towards EVs, we have this idea that we want everything to be more climate friendly. So how do you ensure with your investments you are making those more climate friendly decisions? You know, is investing in the metals like a sustainable investment, or a way towards sustainability?
I mean, part of that also is, you know, responsible investing and, you know, climate friendly investing or ESG friendly investing. It requires, once again, additional capex, right? I mean, especially when you look at, you know, when you look at certain projects where, you know, your tailings dam or your tailings stacking is going to cost an extra $100 million, $200 million, whatever it might be. It's a funding question as well. You know, obviously you have to have the right approach to it, but, you know, the execution of that approach and guaranteeing climate friendliness also requires capital at scale with large capex numbers. So that's, I know, sound like a broken record, but that's definitely, I think in my mind, one of the levers to execute on climate friendly investments as well, in addition to policy certifications. But to get there, you need the capital as well and understanding of how to implement it.
Yeah, when we look at different assets as well, yeah, kind of previous answer is that we're looking at it from the long-term view of it. So not just, you know, trying to get the production facility up and running, you know, as soon as possible, but trying to have some intentional flow sheet analysis on, you know, how much HF is being put into the process, how much reliance upon electricity and gas goes into the operation. You know, where is that electricity coming from? Is it coming from hydro? Is it coming from coal-fired plants? So we do a analysis when we look at the flow sheet of any of the companies that we're evaluating to see how they've already gone and done their plans, and if there is an opportunity to be able to divert that so that in the long term there would be a more favorable outcome from a carbon emission standpoint, then we have that conversation with the companies to say, hey, if you can do this, not that we would be willing to pay a massive amount more, but it certainly would be something that we would consider as we do believe that there's a premium to be paid for carbon capture and making sure that we're contributing as much as we can to lowering that as much as possible.
Okay, so thought we could just broadly look at a few of the main kind of risks and opportunities that you're finding at the moment.
Certainly risk is the low commodity prices, so a lot of companies are under pressure from that. So it's from a buying perspective, it's great in that we can, buy lithium for, close to the historic lows. We can buy nickel for close to historic lows, but it's not good from a sustainable supply chain perspective in that many of the companies that are involved in those spaces will cease to exist if the price point stays where it is. So we definitely see a risk associated with trying to just float the market where it's at today and having multiple sources available in the future as demand grows. So we're trying to do solutions in which we're trying to meet in the middle with producers, being able to offer them a contract in which they are guaranteed to make money and that there's a margin built into the pricing structure, but there's a cap on the amount of exposure that we have to the material market. So these sorts of arrangements, flat price arrangements, as well, are things that we're trying to do to be able to help the supply partners who are out there who are struggling with the low commodity prices and trying to find a way of getting the capital necessary, proving out a IRR and NPV necessary for outside investment to come in and fund their project. So we, in the current status of things are working towards these arrangements so that producers are able to go and get financing and fund their projects.
All right, so I thought we could just close with looking at, the next year or two ahead, or maybe till the end of the current U.S. administration. What do you think are going to be some of the key themes or key drivers for how you make your decisions or for the industry overall?
U.S. administration issues. You take that one. I still want my visa to.
Yeah, certainly what goes on in the U.S. and our major market is going to affect us significantly. So, like I said, even though there's instability with how things are going to net out with some of the battery-specific regulations, the material-specific regulations, I do believe that it's a fair way of hedging your bet by getting domestic supply of things where possible. There's certainly some hurdles to get through, but I do believe trying to find localized options for us will be critical in making sure that we do mitigate the risks of changes of administration and changes of tone, I would say, with the international community. But also, Lucid is growing internationally, so we are building a site in Saudi Arabia, so that does give us an opportunity to work with other providers that are going towards that region. So we're not entirely U.S.-centric in the sense that we can only build out, a U.S.-based market. We have to build out a globalized market out of both locations over time. So it will be an interesting, bifurcation of our business, kind of looking towards domesticating as much as we can in the U.S. with also trying to work in Saudi Arabia and try and do the same thing there.
Those were kind of all the questions that I had for these two today. So I want to thank you for joining us here on this panel.
Thank you for having us.
Thank you very much.